hot wings, hot topics, and real estate. Host Ryan Spellerberg keeps it real with agents, investors, and insiders every month. No fluff, just good convo exploring the trends, challenges, and questions shaping today's market. Now, here's your host with over 20 years of lending experience, Ryan Spellerberg.
They're on fire. Hey everybody, Ryan Spellerberg with another episode of Hot Topics here. We got some fun accounting conversations again. I know you guys love accounting talk, so do I, especially when it's real estate related. So we got Nate Hall here. He's going to have some fun. So go ahead and get after your first wing, which our sponsors are Atomic Wings. They do a great job. First one is super easy, medium buffalo. And Nate even said he went in and did a trial run to make sure he was going to be okay. So he's good with heat, will be fun. And he brought
little plug to Pomegranate Market. Thank you for saving my life today with a little bit of.
Brought a jug of milk.
Not just a little bit of milk.
Yep.
A fair amount.
You're going to be great. Okay. So today's guest is a no-nonsense accountant who's built his entire firm around one thing, real estate. Nate Hall is the founder of HBT, specializing in cost segregation, studies tax advising and accounting for real estate investors, property managers, contractors with clients all across the country. So if you own investment property and you're not talking to someone like Nate, this episode's for you. Nate, welcome to the show.
Thanks for having me.
Absolutely. Thanks for coming. First wing, super easy, right?
Nothing.
Okay, good. This is going to be easy for him.
You'll be able to tell with me because my head will sweat.
Got it.
So there'll be like
there'll be signs.
Heatometer coming off my head.
Signs. Fantastic. Okay. First question. Give us a little background on who you are and what led you to not only start your own firm, but plant your flag specifically in real estate.
So I'm a Sioux Falls guy, grew up here. Both of my parents grew up here. Some of their parents grew up here, so I'm not biased at all. I'm a little bit of a hometown guy.
Love it. Love it.
My wife's family's the same way, so we're pretty rah-rah go Sioux Falls folks. I just had like a really idyllic 90s childhood here, and I just felt like it was the greatest place on earth. It was such a wonderful place to be. But anyway, so grew up. Was kind of honestly a little bit of a troublemaker, and
most CPAs are,
right? Yeah, well, yeah, that's right. I'm really on brand with that. But and when I turned 18, I joined the military. It actually helped me kind of get my poop in a group, so to speak.
Usually does.
Yep. Went to school for accounting. I was actually doing pre-med because I was a medic in the Army, and I was doing some pre-med courses, and something about that lifestyle of like 80-hour-a-week residencies and like maybe your family not knowing who you are kind of piece of it. I was like, okay, so pivot. And I kind of wound up in accounting. So it wasn't like my life's calling. I didn't like, I don't have little.
But now it's your passion.
Yeah. Yeah. Right. And so I figured out that I like numbers and I like that part of it. So got after it. Let's see. Was in the military. Then after I graduated from undergrad, I moved to Denver, worked for the city of Denver for a few years. Then I did grad school. I was there. I have a master's of taxation, which is a super sexy party topic.
Man, picking up
everybody's
all the
like,
chicks.
what?
Yeah, right. Yeah.
And then when I finished, I came home and I worked for kind of both of the two large firms in Sioux Falls for a while, and then went out and started my own thing. When I was at the large firms, I was doing real estate stuff. I was doing cost segregation studies. I was working with, so I kind of, they kind of tell you, hey, we have some clients that need help. You do this thing. And so I kind of fell into that. And then I married into a family who's a big development family in Sioux Falls.
We'll get into that.
Yeah. So there's sort of a hole in their roster too for the accounting, piece of things and sort of financial projections too. So it was just like a natural fit. And so when I went out on my own, I chose real estate as I wanted a specific firm because the tax code's really tough. There's a lot. It's a really thick book. You ever seen that thing? It's big. And if you're getting in front of a generalist CPA who's like, hey, I know all of this stuff, they probably don't.
Usually if it's a small town CPA that has been doing your books for 40 years, they're probably not up on the latest codes.
Probably not.
Yeah.
Right? Yeah. So my thing was like, I want to give people really good service. I want to make sure I'm doing a good job. Well, if I focus on something, I could do it really well. And there was some other pieces to that too as well. But so I went out and started HBT about 7 years ago, kind of screwed around for a year, maybe took a gap year.
Yeah.
But I've been really pretty serious about it for 6 years now. We have 8 people on staff. We're closing in on 7 figures revenue and we're growing and just really enjoying what we do.
And everybody works remote?
Everybody. Yeah. I had an office in downtown Sioux Falls, and like I kept every new employee like, hey, you want to be office or remote? This hybrid thing where like I'm going to have a half of a desk for you and keep that space. I wasn't into it.
Yeah.
So I was either like all remote or all in the office. Everybody was like all remote.
Oh.
And so I was sitting in this office by myself for like about a year or two, and I was like, enough of that.
As long as you get good people and they can do their jobs.
We hold them accountable through standards and their output, not necessarily. I don't care what they're doing at 11 o'clock on
Sure.
Friday.
Yep.
I don't want to know.
It's a result.
They get the results.
Good.
Yeah, so that's how we roll.
You're going to have to get after the second one. Next one's Nashville Dry Rub. This is our favorite because it's just good base heat. You've already had it before. You said you're good with it. So as you had talked about, family relations are into real estate. So you're involved in a significant development in downtown Sioux Falls, $200 million plus project. What were some of the most interesting challenge you had from navigating a project like that, especially from the accounting side?
Well, first, I don't want to overstate my involvement at all.
You did the whole thing. Jeff had nothing to do with it.
No.
Okay, got it.
My father-in-law, Jeff, and his daughter, Ann, were kind of the main drivers behind it, along with a partner of ours, John. Those were kind of the main drivers, but I was part of the team, in particular doing the initial financial analysis when you kind of decide, should we build this thing? Well, it's like, well, I don't know, right?
Yeah.
Well, look, how much could we charge for an apartment, or how much could we charge for some office space? And you've got to back into a lot of math to try to decide whether or not you're going to go forward with the thing. So that part was cool. The other piece is, at the beginning of a big development project like that, it's like chickens and eggs problem. You can't get the general contractor until you have the financing in place. And the financing wants to know that you have a general contractor in place. And, you know, in our case, we wanted to build density because the city wanted density.
We do.
That's what the city was putting out in their proposals. Hey, if you're going to build here, you have to do density. Well, parking ramps don't really pay for themselves. And
What? That is weird.
They don't generate enough revenue to pay for themselves typically. So we got some TIF on that project, but you know, the lender doesn't want to lend to you until you get the TIF, and then so there's this.
And then
like,
you don't get financing until you got tenants, and then
they won't. So those big office tenants, you know, shout out to Bancorp and Eide Bailey for being really mavericks and committing to that project.
Yeah.
You can't get it done until all this stuff falls into place. So at the very beginning stages, you have all this kind of like people sitting around a table, kind of looking at each other, like, "Are you gonna pull the trigger? Are you gonna, and that it's like it was pretty intense and neat to be a part of that."
Any specific item that kind of tipped the scale for everybody going forward?
You know, I think without our two key office tenants that committed their leadership, if they wouldn't have seen the kind of vision for downtown Sioux Falls, I don't think it would have happened.
Yeah,
I would say that was. I mean, we could have maybe done something different and maybe done less office or something to that effect. But the project as it stands right now wouldn't have gone without our big, forgive me, and ISG and Market Beat. We had all of them commit all at the same time. I just kind of state Bancorp and Eide Bailey because they were such large
biggest
square footage. Right. So, but all of them committing to the office really helped, and it was pretty amazing.
And looking at it now, I mean, looking at what has happened around that area, what's going to happen with Smithfield moving out of Sioux Falls, it's just going to be awesome down there. Not that it isn't already, but man, you guys hit it a perfect time.
How do you develop another 130 acres downtown?
I don't know.
And then there's the river line.
Yeah.
Like, how do you fill all that in without, I don't know, goofing up the already good thing we have? And let me be very clear. I am super. I grew up here.
Yep.
Seeing Morels down. I called it Morels.
Right.
Downtown, right? And so I'm over the moon when I heard that announcement that they're going to move out and stay in town. So it's just,
to me, staying in town was the number one thing. Second thing is being able to redevelop that. That's a bonus to me.
Huge. So they're great jobs, and I think Smithfield has been a jumping off point for a lot of people coming to Sioux Falls trying to make a better life for themselves.
Yep. It's the American dream.
Love it. All for it. But what the heck do you do with all that space?
It's going to be a lot. It's going to take, they're talking, it might be a 50-year development down there because you're doubling the size of downtown.
I'm calling it. We need a Major League Soccer team.
I was thinking the Chicago Bears. Personally,
Personally,
they have not committed to Arlington or
So we've got
Hammond,
a
Indiana,
chance.
so there's a chance. No state income tax.
Oh.
I'm making calls. I would support a TIF for that for sure.
you know, Green Bay has a professional team, right?
Do they?
Oh, hey, easy now.
Got it. Okay.
Easy now. They're the old. It's like football royalty here. I'm not necessarily a Packers fan, but there's respect where respect is due. Anyways, but we're a small but mighty town.
Yeah.
I actually think we could support. Probably not the Bears. We probably couldn't get there, but maybe
Just never know.
League soccer team.
Hey, not a soccer guy, but well, if it drives revenue and makes that an amazing space,
We
I
need
would
some
support
big
it.
anchor, some big
Right.
exciting anchor,
Yeah.
and I don't know what that is yet.
Number 3 is Hot Buffalo. So
Okay.
again, get after it. Super easy. This is one that's near and dear to me, but having an accountant on here should be helpful. So big debate for real estate investors. Should I pay cash for a home or a rental property, or should I finance it? What's your take on that? Because there's a lot of different pieces to that.
Depends on your position in life. Ooh, down now a little bit.
Yep.
That was
Well-
the first actual heat I've gotten.
A little bit.
If you're super wealthy and you have a bunch of cash laying around, why would you screw around with banks, right? But I mean, like the restrictions that come with mortgage financing, right?
Yep.
But if you are building a portfolio, you can use it as leverage. So if I only have $100,000 in cash, if I can only buy a $100,000 building, I'm limited, right? But if I have $100,000 in cash and I could leverage another $300,000 and I could buy a $400,000 building, I can scale up. And so most folks that are trying to build and move forward in a big portfolio should probably leverage. The question is debt to equity, or I'm sorry, loan to value.
Yep.
So it's like, okay, I own $1 million worth of property. How much total debt do I have? If you have $600,000 of debt, you have 60% loan to value, whatever. I see people get in trouble where they think 85%, 90% loan to value, or
Not in the commercial world.
yeah, they're trying to push that. That's where people make mistakes is over leveraging, not necessarily leverage on its own.
Yeah.
But for folks starting out and building a portfolio, absolutely they should use leverage, in my humble opinion.
And have good reserves.
Yes.
A lot of people are talking about no money down, use other people's money. That works until it doesn't work.
Well, here's the thing that everybody does. They pro forma a property, right? They say, okay, rent's this much a month. Here's my property tax. Here's my insurance. Nobody ever puts in for capital improvements.
Nope.
Nobody ever has a reserve to say, well,
You
my
never have
water
to
heat-
replace a roof.
Yeah, no, that never happens, right? Or I'll just use insurance or whatever. They don't factor that in. And when you factor that in, a lot of things don't pencil. And that's where people don't want to know. They don't want to factor it in because that makes it not work. And so it's like, well, you should put some number in there for capital.
You need to.
Something.
Yep. Yeah. I always turn it around on people when they come in, and depending on their situation, I've got cash to pay for a house. Should I do that or finance? A lot of investment advisors will tell them to finance because they can get a better rate of return in the market. Theoretically, yes. But when I ask them, okay, if the house were paid for today, would you do a cash out refi to put it into the market? And then they'll look at me going, no, I wouldn't do that. Well, that's what you're doing effectively by not financing it up front. If you're not paying cash up front, you're doing the same thing. So it's just a mental thing for some people, but you got cash. I'm a cash guy. I know I'm in mortgage, but you got cash. For most people, depending on their situation or if they're growing a portfolio, absolutely leverage.
I'm stealing that. I'm gonna steal that saying.
Steal it away. That's just kind of something I live by.
Would you refi your house and put that into the market? No.
Most people would say no to
say
that.
no, right?
Yep.
Yeah. Okay. I like it.
Got it.
Yeah. I have struggled because I have a 2.8 mortgage, 30-year mortgage on my personal home. And it's like, I'd love to just be debt free and not have to make that mortgage payment every month. But the accountant in me can't pay down 2% money when I could have it somewhere else. But that's a pretty big spread.
Correct.
Whereas now it's more like 6% money versus 10% money, I think.
Yep.
Yeah.
Okay.
Anyways.
Number 4, mango habanero. This is a sweet treat. Very easy going. Super easy. Again, you're handling it well. There is a little bit of glisten coming off the top, I think.
Mm-hmm.
What's the number one mistake people make from an accounting standpoint when they're involved in real estate?
Oh, man. Well, I'm thinking tax, right? Because my nerdy brain's like, when you mean accounting, do you mean like doing the accounting, like the books, or do we mean tax law?
Tax.
All right, tax law. Not thinking about depreciation, the cost segregation move. So honestly, for most people, it's not going to work. Because if you're a mortgage lender in your day-to-day and you go buy an investment property, you can go get a cost segregation study done, create this big paper loss, tax loss. It's not going to come over here and eat up your W-2 from your mortgage.
Passive active income.
Yeah.
Right.
For most people, it doesn't work, but at least ask the question. Some people don't even ask. And go, okay, well, I just bought this real estate, and I'm just depreciating over 27 years. I'm not doing anything special. They're not thinking about it. So I've actually had really large, like tens of millions of dollars projects where folks didn't think about cost segregation appropriately. And that's wild to me, because that's like the whole play in real estate is I'm going to buy this $500,000 building, and the first year I own it, I get about $100,000 deduction. Oh, well, my income over here is 80 grand. Well, okay, now I paid zero in taxes this year, and this thing's kicking off cash flow.
Yeah,
hopefully, if it's a good investment.
It should be, but at least you get part of your down payment back. It's a great way to go.
I would say second biggest mistake, since you asked for two, is treating real estate as if it's passive. There's all these gurus on Insta page and all this stuff on the interweb, like, hey, you can just, mail in your money, or was it, Yeah, you can get money in the mail, right? I don't want to say the phrase because I know that. Anyways, that's not, there are syndicated investments where you can just mail a check to somebody, they'll go do everything, and they'll mail you a check back.
And that is much more passive than owning the real estate yourself.
Way more passive.
Yes.
But you're probably not going to get the tax benefits from it because it's passive. You can't take it to offset your W-2 income. But also the returns aren't as good.
Yeah.
So if you were to go buy that apartment building directly with a group of investors or something versus, there's a bunch of soft costs and fees and stuff in the middle between.
They're not doing it for free.
No. So, you get this 8% return, whereas in, directly held real estate, you might get a 15 or 20. You could go higher if you get lucky, buy the right thing. So but for most people, they think I'm going to go buy a duplex that I own and it's going to be super passive. That is not true. You have to think about it like owning a small business. It's like, I have my main gig, my main hustle. I'm also going to have this small business, and I'm going to treat it as such. There's competitors in the market that are also trying to rent apartments against me. There's marketing, there's, strategy. There's all these things. It's not as intense as a real full-time business, but it's a small business, and you should treat it as such.
And we've got good property managers for our stuff, and I know what you guys do with yours. It's still, even with property managers, there's some work to be involved in it. So if you're going to own it yourself, plan on a little bit of labor. I mean, there's just going to be things you have to do.
Absolutely.
If you want it run well.
And if you want some of the tax benefits, you might actually want to go do some of those things yourself.
Right. At least year one.
Yeah. Yep. The first year. So buy a property in December, and then you need 100 hours and more than anyone else
for a short-term rental.
Yes. And you could put in, or you could just do everything you could do 20 hours in December. And then there's actually a test most people don't know. It's called substantially all. So there's 3 tests. It's 500 hours. If you can't meet that, then the next best is 100 and more than anyone else. If you can't meet that, there's a substantially all test. So if you did substantially all the work on a given business activity, then you're materially participating, which means blah, blah, blah. So yeah, that's the best fact pattern. Buy a short-term rental every December.
This is why you talk to guys like Nate. I mean, because he will find ways to help you.
And that's what I'm trying to do is I'm not trying to sit and nerd out about tax law, because most people have other lives and they don't want all the intricate details of that. I'm just trying to find the people who already have the fact pattern that fits. You're already a real estate professional by virtue of being a property manager, or because you're a realtor, or because you're a builder, a contractor. You don't know that you're a real estate professional when you're a contractor. And so you could go invest in real estate and get this great answer. And here's how you do it.
Yeah. That's why I preached every real estate agent should buy a rental every year.
Yep.
Offset normal income, because they qualify for that right out of the gate.
Easy breezy.
Yeah.
You're going to do it. And let's clarify. If you have 80 grand of income, and you have a family and stuff, you can't go out and spend 50 to 100 grand a year and have a down payment on a rental property. This is going to be for folks that are making more money, and you have, let's say, 400 grand a year of income, and you're wise and don't blow it all on, trips to the Dominican or whatever it is. You have enough sense to save some money And whatever leftover money, it's like the choice is, do I put that in my 401k or in stocks or bonds? Real estate's an option for those folks.
Yeah.
And if those folks are also realtors or contractors, that real estate option becomes a lot more attractive.
And you probably see the spouse of somebody that has high earning potential maybe get into that real estate professional role as well.
That's a great fact pattern.
Yeah.
I've got a client who's a physician, and she makes really good money. Her W-2 is a really high number, and her husband stays at home with the kids, and he's real handy and can build. So he buys rentals, he fixes things up, he does a lot of the work himself, which means they materially participate. He qualifies for the 750 hours and more than half test, the real estate professional test, does all that. So they're getting these big losses on these rentals, and they're offsetting her W-2 income.
Yep.
Which is magic, because typically W-2 income's really hard to plan around. It just is. It's like, here's your income. You can't like deduct your cell phone against it, because that's not how that works.
We're such nerds. Sorry, guys.
Yeah,
I love it. I love having these conversations.
Yeah,
that's even though I sweat less, I think.
Yeah, well, you have hair, so that's the thing.
That is true. Number 5, atomic. You said you've already had this. Again, pretty easy going.
Right.
We're getting after that. So we kind of covered it a little bit already, but you guys can actually perform cost segregation studies. So give us a 30-second overview of what that is and why somebody needs or who should be doing those. We've kind of covered a little bit, but we didn't really tell people what a cost segregation study is.
Okay. So that's not bad yet.
Yeah, see?
In my trial run, this nuclear, that's going to melt my face off. So that's what I'm worried about. The rest of these I can go with. Okay. So if you go and close on, let's say, a $400,000 duplex, you're going to go and you're going to write a check to somebody for the bank will, whatever. You're going to bring $400,000 to close. It's like, did you buy one $400,000 asset? No. You bought some land. You bought a building. You bought appliances. You bought carpet. You bought a roof. You bought, landscaping. You bought all these different things. Well, how do I take, because nobody told me when I bought it, how much was the value of the water heater? So you've got to have some kind of method to split that value up. And the IRS respects this. They say, okay, if you get professionals and you do this correctly, we will allow you to take that big $400,000 number and assign, let's say, $300,000 to the water heater, right? And then you can depreciate that as like a standalone asset. Well, water heaters are part of the building, so they have to be depreciated over 27 and a half years. However, your landscaping or your driveway, that's considered a land improvement, and that can be depreciated over 15 years, but 15-year assets qualify for bonus, which basically means you get to write off the whole thing. So let's say you like cowboyed this and just did it on your own, right? So you bought a $400,000 and you're like, I'm not going to pay this jerk to do a cost seg. I'm going to actually just guess at what the value is yourself. Honestly, you'd probably be okay. Like especially if you don't get audited, right?
Yeah.
Right. But if you were to get audited, you might even like win a little bit if you could prove where you got the values. But what we do is we use a very formalized method that's based on some like national software that takes and breaks apart the building and assigns values appropriately. So that if you are in that position where an auditor says, hey, how'd you figure out $3,000 for the water heater? You can hand them this document from us that says, hey, I had a professional break apart the values. That's what a cost segregation is.
Yeah.
We're segregating this total cost into individual assets. Well, some of those assets qualify for faster depreciation. That's how you get a bigger first year deduction. That's what cost seg is. And so lots of people do cost seg, I'm sure, if you're in the real estate
I don't think a ton of people do.
Really?
I don't think so.
That's wild to me.
I don't think a lot of firms around here do cost segs.
It's like people cold calling you all the time and sending you, emails. I do cost seg. It seems like
not locally, I wouldn't say.
Well, so the reality was, and I worked at larger firms and we did this, whatever, is just really high margin work.
Right.
It's not that wildly complicated to do. And they were charging a lot for it. And I just think it was such a mystery to everybody. So like the margins in cost seg were like way up here. So everybody wants to do cost seg because it's magic. Nobody really understands what it is. And so I kind of came into it and was like, I could do way less margin on that and still crush it. Like there's so much margin in there. It's wild. So what we've done is we've created a process that does it a little quicker. We're all digital, we're efficient with it, and then we charge less and we do cost segregation. And that's been really the thing that's usually like our entry point with people. We'll talk to them about cost segregation, and that's one other piece of that is some of these folks will go around and sell cost segs, but not ask you whether you're active or passive, or whether you can use it or whatever. They just say, hey, you want a cost seg? Here you go. And they charge you $4,000 to do this cost seg, and they don't do the part that actually counts. Is like, can you take advantage of this? And I've seen that a few times. We're just like, oh, I bought this cost seg and they didn't tell me that I couldn't use it.
Yeah, you got a nice passive loss that carries over forever. That you're never gonna use. It's great.
That's worthless. Well, not worthless. If you get to be really like rolling in it and you have a bunch of passive income, you might actually want to leave it in the passive bucket. Like still do a cost seg.
Explain that.
Okay, so like you have active income, active loss, passive income, passive loss. Passive income can offset passive loss. The two can offset each other in these buckets, but you can't generally cross them.
Can't cross-mogenate.
You can't bring passive loss over into the active bucket. So if I own a property that creates this big on paper $200,000 depreciation loss, and I'm a $300,000 a year physician on my W-2, that's active. The two can offset unless you participate in it, you hit those material participation tests, your real estate, all that kind of crap. So you'd have a bunch of loss sitting over in this bucket that you couldn't use, and you'd still have to pay tax on your $300,000 this year.
Yep.
But maybe you get to a point where you're so wealthy or things are going so well for you that you own 40 properties and you have all of this taxable income in the passive bucket. And then you buy a new property, you just leave it in the passive bucket because it's offsetting all this passive income.
Got it. Okay, that's when it would
So
make sense.
so like at some point, if you were like really doing well, just leave everything in the passive bucket.
Yeah.
You don't need to qualify as a real estate professional
Because you're still going to use it anyway.
because you're still going to use it against your. Yeah, I got another client has multi 7 figures of rental income, taxable rental income each year, even after the normal 27-year depreciation still has that. So he has to buy properties every year to knock off some of that.
Tax burden.
Yeah, but he's actively participating in it, so we have to do the active bucket thing.
Yeah.
So going back to my point. Point is, somebody shouldn't sell you a cost seg and then not do the advising behind it and like talk to you a little bit about. And so we won't sell cost segs unless we get a chance to talk to the people.
So I shouldn't sell you gas and then look at you drive away in your Tesla.
Yeah, right. Yeah,
Okay,
yeah.
got it.
That's the key.
Got it.
We think.
I think he's stretching this on so he doesn't have to get after his last wing. Last one, nuclear from Atomic Wings. Amazing. Okay, so really, I mean, who calls you? Like, who is your best client that you can think of? Who do you want to give you a call after this show? It's obviously a real estate investor, but maybe that mom and pop that's got 4 or 5 rentals is a good start for you, or is it the Jeff Scherslicks of the world that you would like those as well?
Did you tone this down?
No, I did not.
Did you change the sauce?
No,
That's not that bad.
it's just not hot. It builds a little bit.
Okay. It's going to come on a little bit, and then I'm going to cry. We want both because we have folks in our firm that are scaled to handle the few duplex client and do really well with that. And their rates, they're kind of billable hour rate. We don't totally do billable hours, but kind of approximate by that.
Yeah.
The cost to that person is more affordable and more aligned with that. I have several duplexes person, and that person can bring me in and say, hey, Nate, there's something funky happened. I need a little advice on this. So there's layers of support with that. Whereas like if it was a bigger, deal or something like that, I can be directly involved in it more so. So what I'm saying is we have the range. I like big gnarly topics that are real scary to me and challenging for me. But I don't want anybody to take away from this that I wouldn't take somebody that's just bought their first duplex.
So your answer is any client that wants to talk about real estate should give you a call.
Here's our rule internally in the firm. If you don't have or plan to invest in real estate, we don't take you like at all. So like you could own a manufacturing company and also have an apartment building and we'll take you. And in some cases we do that. I actually was outsourced CFO for a 50-person manufacturing company for a while, a couple of years ago. And so like we can do more than just real estate, but if there's not that real estate component somewhere in the mix, we say no, and we have a list of local accountants we refer to.
That's great.
So you have to be like, I have a gal that's like, hey, I'm a realtor this year, and next year I'm going to buy my first rental next year. Cool. You know, that's fine with us. But you either have or intend to invest in real estate directly, not necessarily indirect, the syndication, or like I own a REIT through my TD Ameritrade account or whatever. Like that's, you know, not what we're talking about.
It's kind of like when people reach out to be on this podcast, unless you have something to do with real estate, it's hard for us to get you on here.
Right. Yeah. How'd my meter go here?
Yeah. I mean, you can see it. You can definitely see it, especially before you got off the top.
Oh yeah. I got to do one of these guys.
Oh, let the mutton chop out. Absolutely.
Oh man, it really like made my core temperature warmer.
Yeah, it gets toasty.
That's nice actually.
So how do people get a hold of you? Like if they want your advice, how do they get a hold of you?
So we are hbt.cpa. It's hbt.cpa. Go to our website. We have a little form where you can put in like, you know, and we check it. You know, you go to websites and they have those like contact us forms, and it's like, I don't know if I'm getting anything here.
Yeah.
We are on it.
Good.
We will. We're a small firm, so we're trying to get away from like having a receptionist. I like to run my own race a little bit. Sure. I like to do accounting a little differently than some people do. So we don't have a traditional receptionist to just answer phone calls. So I prefer digital. Come through the website. Let us know. We'll be on it. You'll get a call back from us very fast.
Awesome. Thanks for coming, man. Thanks for watching. Make sure to like, subscribe, do all that fun stuff. Ryan Spellerberg, Mortgage Guy, signing off. Appreciate it, buddy.
Thanks.